computer. Screen. All right. Can everyone see this okay?
Yes.
All right. So, hello everyone. Thank you for coming. Today I'm going to be giving a presentation on our stock market game. I sent out an email earlier today, giving you guys some updates on that. And then I just sent out an email about an hour ago with the update on the start time. Our budget was approved and we were able to purchase the stock market and get it like all set up. So it will start tomorrow morning as originally planned. So that's good news. And then it will end December 7th as originally planned. So in terms of that, that's all good. So today I'm going to be talking about registering for the game. Most of you are already registered. I'm going to talk about some of the game rules, and then I'm going to give a short overview of the stock market and investing. I know this is scheduled from 8 to 9. I'm hoping we can finish earlier. So yes, as I'm going through this, if anyone has any questions, you can either use the Zoom raise your hand feature, or you can just interrupt me and ask a question. There will also be questions at the end, but for some of the things, it might be better just to ask a question in the moment. So before I begin, does anyone have any questions? All right, cool. So let's get started. So by now, you probably all should have joined the game if you're here. If you haven't, and for the people who are going to watch the recording of this, you can scan this QR code that will take you to a Google form where you can fill out your information. And then after you fill out your information, you get put on a form, and then we send you out an email. Earlier today, I sent out game rules, which is another form that I'm asking that you all fill out. Some of you have already filled it out, so thank you. I appreciate that. We have a couple game rules, and I'm about to go over those. And this just makes sure that it tries to ensure that you read the rules and agree to the rules, because we don't want any issues during our game, and we want everyone to have a good time. And I don't really want to have to kick anyone out because they're misbehaving, or because I can't identify who you are, or whatnot. So everyone who signed up for the game should have received an email. It was around 7 o'clock with the link to go fill out the form with the rules. After you fill that out, after this meeting, I'll be sending out the link so that you guys can join the game. And I'll be doing an overview of the Wealthbase website too. So yes. Angel, do you have a question?
Yes. So are we going to be using Monopoly money or real money in this game?
It's fake money. I'm going to go over that. But so the way it works is you're going to get $100,000, virtual dollars, to invest for 10 weeks. And then whoever has the most virtual dollars at the end wins.
All right, thank you.
Yeah, so this costs you nothing. Yeah. So yeah. Any other questions? Right. So let's talk about rules. So we do have some rules for when you're playing the game. Our first rule, and probably the most important rule, is that when you sign up for Wealthbase, you have to use your PNW email address, because we're paying for this game, and so we want to be able to identify you. And so if you're not using a PNW address, you're just going to be removed from the game. This is to prevent people from making duplicate accounts and from cheating, or it's just to make sure that you're the person who registered for our game, because we only have a limited amount of seats available, and so we want the greatest number of people to be able to sign up. Our second rule is to be eligible for prizes, you have to trade at least one thing over the course of the game. So Wealthbase actually has a feature where there is a leaderboard in game, and so you'll see in real time who's winning, right? And so in order to be eligible for the leaderboard, you have to make at least one trade. And so that's going to be our rule too. You can't win the game if you can't make any trades. Because we don't want, like, you get $100,000 to start off with, and so we don't want you to join the game, have the $100,000, not make any trades, and then, you know, the last week of the game, the stock market tanks, everyone loses money, but you're still sitting with the 100,000 because you didn't trade anything. So yes, one trade over the course of the game at a minimum. Now we'd like you to trade more, but one at a minimum. Our third rule is that your trade must come within the first 2 weeks of the game. We're paying, we pay for this game per person, and so we want you to be active when you're playing the game. And so if you don't make a trade within those first 2 weeks, you're just going to be removed, and then so we can replace you with someone who's actually going to play. So Wealthbase has a kind of in-game social feed where you can leave comments about stocks. Whenever you buy or sell something, it will prompt you to make an update to your feed. And so that gets displayed kind of on the landing page of the game. And so we're not going to tolerate inappropriate behavior in the in-game social feed, just at all. Inappropriate posts are going to be removed, and if you keep on doing it, you're going to get kicked. Now I'm hoping that we're all, you know, adults and we can behave and not post inappropriate messages, or I even think there's a picture functionality. So just please keep it clean and appropriate. Rule number 5 is that your in-game username should be at a minimum your first name. I'm going to go over that when we go into Wealthbase. That's just so we can identify you better, and so that your peers can identify you better. So we don't have some crazy name at the top of the leaderboard and everyone's like, who's that? And then rule number 6 is, of course, have fun and learn about investing. Does anyone have any questions about the rules? Okay. Well, if you do, either you can ask me at the end or you can shoot me an email. Yeah. So, intro to the stock market. Now, this is going to be a pretty brief presentation because the stock market is a pretty deep subject, and I could give, you know, there's classes taught on this. So this is just going to be an overview. For some of you guys who are familiar with the stock market, this is going to be a lot of things you probably already know. But this is more geared towards stock market beginners. So first, we're going to watch this video. Hopefully this works. Can people hear this? Now, let me figure that out real quick. Oh boy.
In the 1600s,
Okay, now you guys hear? All right.
In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices, and silks around the globe. But running this massive operation wasn't cheap. In order to fund their expensive voyages, the company turned to private citizens, individuals who could invest money to support the trip in exchange for a share of the ship's profits. This practice allowed the company to afford even grander voyages, increasing profits for both themselves and their savvy investors. Selling these shares in coffee houses and shipping ports across the continent, the Dutch East India Company unknowingly invented the world's first stock market. Since then, companies have been collecting funds from willing investors to support all kinds of businesses. And today, the stock market has schools, careers, and even whole television channels dedicated to understanding it. But the modern stock market is significantly more complicated than its original incarnation. So how do companies and investors use the market today? Let's imagine a new coffee company that decides to launch on the market. First, the company will advertise itself to big investors. If they think the company is a good idea, they get the first crack at investing and then sponsor the company's initial public offering, or IPO. This launches the company onto the official public market, where any company or individual who believes the business could be profitable might buy a stock. Buying stocks makes those investors partial owners in the business. Their investment helps the company to grow, and as it becomes more successful, more buyers may see potential and start buying stocks. As demand for those stocks increases, so does their price, increasing the cost for prospective buyers and raising the value of the company's stocks people already own. For the company, this increased interest helps fund new initiatives and also boosts its overall market value by showing how many people are willing to invest in their idea. However, if for some reason a company starts to seem less profitable, the reverse can also happen. If investors think their stock value is going to decline, they'll sell their stocks with the hopes of making a profit before the company loses more value. As stocks are sold and demand for the stock goes down, the stock price falls, and with it, the company's market value. This can leave investors with big losses, unless the company starts to look profitable again. This seesaw of supply and demand is influenced by many factors. Companies are under the unavoidable influence of market forces, such as the fluctuating price of materials, changes in production technology, and the shifting costs of labor. Investors may be worried about changes in leadership, bad publicity, or larger factors like new laws and trade policies. And of course, plenty of investors are simply ready to sell valuable stocks and pursue personal interests. All these variables cause day-to-day noise in the market, which can make companies appear more or less successful. And in the stock market, appearing to lose value often leads to losing investors, and in turn, losing actual value. Human confidence in the market has the power to trigger everything from economic booms to financial crises. And this difficult-to-track variable is why most professionals promote reliable long-term investing over trying to make quick cash. However, experts are constantly building tools in efforts to increase their chances of success in this highly unpredictable system. But the stock market is not just for the rich and powerful. With the dawn of the internet, everyday investors can buy stocks in many of the exact same ways a large investor would. And as more people educate themselves about this complex system, they too can trade stocks, support the businesses they believe in, and pursue their financial goals. The first step is getting invested. Interested in pursuing your own financial?
So yeah, that's a kind of overview of the stock market. Oh wait, stop. Sorry. So now we're just going to go over some of the types of investments. So the most common things you'll come across are, and mainly what you'll trade in the stock market game are stocks. These are also known as equities. And so stocks represent ownership of a fraction of a corporation. So a corporation, they have their initial public offering, they sell all these stocks called shares, as a share of stock, right? And then you can buy those, and then you own a fraction of the company. This entitles the holder to a proportion of the corporation's assets and profits, and this depends on the amount of shares that they own. And so stocks are primarily traded on exchanges. And so some examples of stocks, we have Google, we have Apple, F is Ford, KO is the Coca-Cola company. So these are individual businesses. Then there's things called ETFs, and ETF stands for Exchange Traded Fund. And so an ETF is a basket of securities, and they trade on an exchange like a stock. So whereas with stocks are individual companies, an ETF might be a basket of stocks that represent multiple companies. And so ETFs can track indexes, they can track sectors, they can track commodities, and they can be good for diversification because they're not just one institution or one type of commodity, they're a basket of them. So some common ETFs, the SPY and the DIA, those are both index ETFs. This one tracks the S&P 500. This one tracks the Dow Jones. You can also have sector stocks. So this is a biotech ETF, and then commodities. So SLV is a silver ETF. So like I said, these can be good for diversification. So you kind of spread your money over a larger basket of stocks rather than put all your money in just one company or one commodity.
I have a question.
Yeah, sure.
Is the Dow Jones like a... Hold on. Oh yeah, is the Dow Jones like an ETF?
So the Dow Jones is a index. So you can think of the Dow Jones as a representation of all the stocks held, or not held, tracked by the Dow Jones. Right, so say, I forget how many stocks are in the Dow Jones, but we'll use the S&P 500 because that one's easy. The S&P 500 is 500 companies, right?
All right.
And so it tracks the total return of all those 500 companies. And so it tells you how the whole market is doing. The Dow Jones is like that, just for a different group of stocks.
All right, that makes sense. Thank you.
Yep. And then there's crypto, which I'm sure some of you know a little about. Crypto is a pretty broad term. It can mean digital currencies. It can mean digital assets. NFTs have been in the news a lot lately. Or digital tokens. So these are not traded on exchange. They're traded on a blockchain, which is more like a peer-to-peer trading system instead of in a formal exchange. Crypto is fairly new. It's also pretty risky. There's some things, it's still a developing market, so there's wild price swings, and you hear about it a lot in the news. Some of the more commonly known cryptos. Bitcoin was the original one. Ethereum, lots of things are based on, or either Ethereum or they're Ethereum based. So lots of your NFTs are based on Ethereum. And then, of course, Dogecoin. So yes, that is, so stocks, ETFs, and cryptos are what are available to trade in our wealth-based game. For the stocks and the ETFs, we're limited to the United States. And then crypto, there's about, I think there's around 15 different cryptos you can trade. They're not all on there because people come up with new cryptos every single day, but there's a pretty decent amount, more of the mainstream ones that you can trade. So when you go and look at a stock, and we're going to look at this in a little bit when I actually go on to our wealth-based game, you'll see the company or whatever. If it's ETF, it'll say what the ETF is called. It'll have the logo, it will have the ticker, it will give you the price and the percent change for the day. And then you can see the chart tracking how the stock or the security has trended over the day. Then there's the option to buy or sell short. So I'm just going to quickly go over what those things mean. So buy versus sell short. Buy is pretty self-explanatory. It's what you would think when you talk about trading. So you buy the stock normally, and then the stock is yours until you choose to sell it. And so the way you make money is when you buy the stock for a lower value and then it increases in value and you sell it, you get to pocket that difference. So you buy low and you sell high. Now there's also this thing called short selling or selling short. And the way this works is that you borrow a stock from someone. In this case, it will be from the wealth-based system, and then you immediately sell it. Okay. And so you're betting that the value of the stock is going to go down. Now you close this, we call it covering the short. And so you repurchase the share. Hopefully you repurchase it at a lower price, and then you pocket the difference. So when you short sell, money is made when the stock decreases in value. Now with short selling, theoretically you could have unlimited losses, because when you buy a stock, say the stock costs $10, right? When you buy the stock, normally the most money you could lose is $10, because you can't have a negative value of a stock. So the most you could potentially lose is $10. When you short sell a stock, there's no upper limit on how high a stock price could go. So that $10 stock could go to $100, and then you would lose $90 on that $10 stock. So short selling can be risky. I don't know if you guys follow the news with GameStop and AMC stocks, but there's been hedge funds that have shorted those stocks, and then now they are taking pretty heavy losses because there's nothing that stops the price of that stock from just keep from increasing, just keeping on increasing. There we go. Yes, Frida.
Now, what if we run out of all the money we have? Can we reset our
No, you
profile?
cannot reset.
Okay.
Yeah, so if you run out of
Will
all the
lend?
money, I will get to that. There is margin trading.
Okay.
Yeah.
Okay.
So just a quick example of short selling. We'll go back to the $10 stock. So $10 stock, you borrow it, you sell it for $10. So then you have $10, but you borrowed it and you have to give that stock back. So if the value of the stock then decreases to $5, you take the $10 that you sold the stock for, you take 5 of those dollars and you repurchase the stock. That's called a cover. And then you still have $5 left. And so that's the money you make. You make that, you get to keep that $5. Also, so when you buy and when you sell, there's 3 options to choose from. There's a market buy, there's a limit buy, and there's a stop buy. So a market buy, you place the order at the market. So what happens is that the order executes as soon as it can at the market price. So stock is trading for $10. You place a market buy, and it will execute at that $10. Now a limit buy, you put in a limit, and so the stock is bought when the price is at or below the limit. So $10 stock, and you put in a limit for $8. So if the price of that stock hits $8 or below, your order will execute and it will buy it at that lower price. And then there's a stop buy, which is instructions to purchase when a security reaches a predetermined price. So in a stop buy, you buy a stock and then you enter a level above your current price. And so you can use that to buy profit from an upward movement in prices because you get to place the order in advance. And then they can also be used to protect your short positions, because remember, shorts can have unlimited losses. So you can use that to make sure that the price of the stock doesn't just keep increasing, and you get stuck in that position. And then sell orders are pretty much the inverse of that. So the market sells it as quickly as possible at the market price. The limit sell executes when the price is at or above the limit. So you might buy a stock for $10 and then set a limit for 15, so that if the stock hits $15, you automatically sell it. And then you don't have to, constantly monitor it to make sure that you sell it in time. And then there's also a stop sell, which is instructions to sell when a security reaches a predetermined price. So what you do is you enter a level set below the current market price. And so if it hits that, it will automatically sell. And so you can use this to protect your long positions from price decreases. So $10 stock, you might set a limit at 5 or a stop at 5. And so if it dips down to 5, you just liquidate your position to mitigate your losses. Margin. So Wealthbase does allow you to borrow a certain amount of money to buy investments. And we call this buying on margin and trading on margin. Now, since you're borrowing money that's not yours, you have a potential to make bigger gains. But the downside to that is you also have the potential to have bigger losses, because not only do you lose the value of your investment, but now you have to pay back the money that you owe, plus any interest that you owe. So this is why it's commonly called leverage, because you can use it to leverage big gains, and it can use you to leverage big gains for whoever's lending you the money. In Wealthbase, you are charged interest on the amount that you borrow. I'm pretty sure that it's charged at the end of every month, I think. And I don't know what the rate is. So maybe poke around on the website and figure that out if that is something you're interested in. Investing 101. Before we get into this, I'm just going to go to the Wealthbase website. So when you type in Wealthbase, can everyone still see this? Okay. When you type in Wealthbase, this is the site you'll get to. If you don't have an account, and I would assume that most of you don't, you're going to click sign up. When you click sign up, you want to hit the continue with Google because you want to sign in with your PNW email. When you do this, it's going to take you to the Google login page, and then it should take you to your boiler key page so you can sign in that way. I have an account, so I'm going to log in. So then this is your dashboard. It will show you the games you're in. This is our stock market game. So I'm going to click on there. So it starts tomorrow at 9:30 a.m. Eastern. So that's 8:30 local. So this is the activity page. Here's the in-game feed I was talking about. So you can comment on this. I can share an update. It will tell you your net worth right here. So the goal of the game, everyone starts out with $100,000. Your goal is to have the highest net worth at the end. At the bottom here, it talks about some of today's movers, the stocks with the biggest percentage changes of the day. Here are some of the US markets. The Dow Jones, that's an index. These are all indexes. We were talking about that earlier. The leaderboard, no one is in the game yet besides me. But this will tell you who's winning. This is a live leaderboard, so you can see who's winning and how much further ahead of you they are. Your performance, I don't have any data yet because the game hasn't started, but it will tell you, I think it tells you how your portfolio is doing, how the average of everyone else's portfolio is doing, and how the S&P is doing compared to you. So you can use that to see if you're overperforming or underperforming. Your portfolio tells you everything that you've bought. And then your history tells you the things that you've bought and sold. So when you go to trade, so you'll have this will give you your buying power and your net worth. These are just the game details. So, okay, the cash interest on the margin account is 0.5% for people who are interested in buying on margin. So you have your stocks here, you have your ETFs here, your cryptos. Stocks and ETFs can only be, or the markets are only active during trading days, which would be 8:30 to 3:30 local time. Cryptos, you can trade any time of the day, but cryptos have a commission. So the commission is 0.15% on every trade. So just watch out for that when you're trading. A commission just means that it takes a percentage of your profits when you buy and sell. Like it takes a little cut of your purchase or your sale when you trade it. The movers in your watch list. So say I was wanting to keep track of Tesla stock. You click this little star in the corner. that adds it to your watch list. And so then it will pop up here. And then the movers, it's separated out. We had the stocks with the biggest gains, the stocks with the biggest losses, and then the highest volume trades. So does anyone have any questions about Wealthbase in particular? All right, well, if you think of something, let me know.
Is there options trading at all? Or you said no
No,
options?
there's
trading,
not
right?
options trading in this game.
Okay.
Yeah, sorry. Okay.
Is diversification rule is something that you set up?
No, the diversification rule is something that they set up and I cannot change it.
Okay.
And I'm about to talk about diversification. Let's see. What is the diversification? It's 20%. So I'll talk about what that means. All right. Back to this. So investing 101. So just a disclaimer. I'm going to be talking about some investing strategies. I'm not an investment professional. If you follow the things that I say in my PowerPoint and it causes you to lose all your money, I'm sorry, but I'm I'm not what I'm trying to say is I'm not an investment professional. So do your own research, especially if you're investing actual money. If you're going to get into actual investing, definitely do your research. There's lots of resources available to you. Yeah, so please do your homework before you start spending real money on real things. So risk and diversification. So stocks and crypto, ETFs, all of these things are risky. And that means they're risky because there's a chance you could lose money, right? And so when you're investing, a way to kind of mitigate your risk is to diversify your portfolio. And when I say diversify your portfolio, I mean buying securities from different companies in different sectors. Now, this is actually wrong. The Wealthbase has an automatic diversification rule, 25%. It's actually 20%. And so what that means is you can't put more than 20% of your cash into one asset. That's just a wealth-based rule. I can't affect that at all. So the buying securities from different companies in different sectors. So say,
Question,
oh yeah, what's up?
if that's all right. So is Wealthbase just a synthetic trading platformer, or can you actually do real investing on it?
No, it's just a game platform.
Okay, all right, cool. And so just as like a stated thing, for any game that you set up, like you said, the most you can invest in one portion from your overall portion is 20%.
Yes.
Okay, yeah. All right, cool.
And it says it on, like when you go to make a trade, it says it on the side. And if you try to go over 20%, it will kick out. It won't let you trade. So, yeah, it's not something you have to like consciously look out for. It will just say, no, you can't do that.
In the beginning, for example, we start from $100,000.
Yes.
We cannot buy one stock worth of more than $20,000.
You cannot buy one.
Yeah, for
security.
example,
Yeah, you can't put more than $20,000 into one security.
okay.
Yes. In the beginning. Now, if you get in there and you make a killing and you double your money, then that of course goes up. So buying securities from different companies in different sectors. So what do I mean by this? Say you have a portfolio with just one stock in it. You bought some Apple stock. And so Apple is in the kind of tech industry, right? And so if Apple does well, that's great, you make money. But if Apple does poorly, then you lose money, and you could potentially lose a lot of money, depending on how poorly Apple is doing. But if you have several tech stocks, say, then you kind of have created your own index of the tech sector. So when the tech sector does well, you do well. And when the tech sector does poorly, you do poorly. Now, to take it one step further, then you buy stocks in different sectors. So there's the tech sector, but say you wanted to invest in the healthcare sector, and then maybe the car industry, and then the food and beverage industry. And so you build all these different baskets and you bundle them all together. And so your risk is diversified across a broader range of securities, and then you're not as exposed to risk. So that's one of the ways you can use to mitigate your risk. And like I said, Wealthbase automatically doesn't let you dump all your money in one security anyway. So it's actually in your best interest to do some diversifying. So when we're trading stocks and investing, there's two schools of thought. Well, there's three schools of thought, but the two main ones are fundamental analysis and then technical analysis. So in fundamental analysis, you try to determine a stock's fair market value. And you do this by computing ratios. You look at financial statements, you assess like economic trends, and you look at other types of qualitative and quantitative factors. And this helps you arrive at a fair market price. And so then you look for stocks that are trading at prices below that fair market price, and you buy them because they're effectively on sale, right? In technical analysis, you try to determine when to buy and sell, and you look at historical patterns to do this. So you look at trends in the stock charts to see what happens previously, and then you try to capitalize on those trends. Now, for not so much for this game, but for investing in general, if you're a beginner, probably your best bet is going to be to purchase index funds. Index fund investors fall under the third camp, so not the fundamental analysis or the technical analysis, but they more subscribe to the efficient market hypothesis, which says that markets are efficient, and the prices reflect all the available data on that stock, on that company. And so you can't really you can't really beat the market. So for new investors, it's probably the best way to start investing. And so the philosophy is you don't try to beat the market, you be the market. So you buy index funds which track the overall market. They look at the overall health of the stock market, and historically that's trended up somewhere between 7 and 12% a year, depending on, or 7 and 12% over long periods of time, depending on who you ask and how you measure it. So it's probably the best way to invest if you're a new investor. You can purchase these either through mutual funds, or there's index funds, ETFs. And so the strategy would just be to buy and hold them for the long term. Now, while this is the best for if you're actually investing, probably, you're probably not going to win the game by buying and holding index funds. And this is because the time horizons on index funds is supposed to be years and years, whereas the time horizon for this game is 10 weeks. So index funds, good strategy if you were going to start investing personally, probably not a good strategy if you're trying to win this game. But it's a good strategy overall, and that's why I'm just talking about it real quick. So some trading strategies. One of the strategies is news trading. So companies are in the news all the time. There's also quarterly reports and annual filings. And so this strategy, you trade based on the news before and after and during the press release. The companies had great quarter results. Their stock might go up, and so you might go, all right, well, let me buy that. End of day trading, trades when markets are near closing. The theory is that towards the end of the day, the prices have kind of settled, and so you have a better idea of what they're going to look like. And then, so you use your limits and your stops to cover any potential losses. Swing trading is buying a security when it's predicted to rise and selling when it's predicted to fall. This is a very technical analysis type trading strategy, and difficult to do because otherwise everyone would be doing it. Day trading is like swing trading, except you close your position before the market closes to minimize exposure. For day trading for Wealthbase, I think the limit on trades, I also can't change this, so I apologize for the people who wanted to make hundreds of trades a day. I think the limit per day is 25 trades. So you can do day trading to an extent, but you can't get crazy with it. Trend trading is kind of like swing trading. It looks for historical trends, and then it trades when those patterns emerge again. So there's things like there's certain patterns that technical analysts look for, and then they trade based on those patterns. Scalping is making small profits by engaging in microtransactions. So that's like buying and then selling instantly to get a couple cents, and then you just keep on doing this. This is something that we can't do in our game, again, because of the 25 trade limit a day. And then position trading would be holding a position for a long period of time. And so this last section is just why should you invest outside of this game? And it's to fulfill your financial goals, right? So you have short-term and medium-term and long-term financial goals. In the short term, you might want some money for an emergency fund or to buy a car. You might, on medium term, you might have a kid one day and want to save money for their college. So there's like programs like the 529 college savings program, which lets you invest for your child's savings. And then your longer term investments are, of course, so that you can retire one day and be financially independent. And then so some of the ways to start investing, we talked about individual stocks. Mutual funds are sort of like ETFs, except they're not traded. They're similar. They are also a basket of securities. More commonly, they're managed, though, by a fund manager. We talked about ETFs. Index funds track an index. CDs are commonly issued by banks, and they're they're low yield but also low risk. US Treasury securities, also low yield, low risk. Real estate securities. If you're interested in investing in real estate, but you don't have enough money to actually buy property, there are real estate securities available that you can invest in, that you can buy like a fraction of a property. And then annuities are things that you can buy that will give you annual payments. And then some of the trading platforms for beginners. Here's just a list of them. I use Robinhood for any day trade. Like I have some Dogecoin on my Robinhood account. There's also longer term type investing platforms. I know Fidelity is more of a longer term. You can buy like index funds and stuff like that. There's also, I have a Vanguard account, and so that's got some of my long-term investments in there. If you want to learn more, there's a whole bunch of places on the internet that can teach you. One of my favorite places to go is Investopedia. Investopedia is actually the site that I used for a lot of the information on this presentation. But yeah, go on the internet or check out a book. There's lots of places where you can learn, and yeah, do your homework before you jump in, so that you are making the right choices. So yeah, good luck. The game starts tomorrow, and good luck. Yeah, to the moon. Does anyone have any questions? Wow, I killed it. No questions.
I wonder what trading platforms everyone else uses, if they do invest. I personally use Robinhood and Vanguard too, but I just wanted to hear from everyone else.
I use like Robinhood and Webull mainly. I also have like a Roth IRA, so I use Charles Schwab for that. And I was using Coinbase, but they have too many like fees and stuff, so I'm not really crazy about them. But if you do use them, you can use like Coinbase Pro, and that's like good access to a lot of cryptocurrencies and stuff.
Well, if no one has any questions, I'm going to stop the recording.